The Federal Reserve just reversed with their big announcement. I have all the details and what you need to know right here in the video, so let's get right into it. Alright, the highly anticipated announcement out of the Federal Reserve was just released a short time ago. Yet again, the Fed came out swinging, raising interest rates by another 75 basis points or 0.75%. Now, this is the second back-to-back 75 basis point rate hike that we've seen so far in 2022. Is there another one on the horizon? Well, that is still to be determined, as their next FOMC meeting is going to be taking place in 6 weeks from now in September. So, between now and then, it is a wait-and-see approach. We will need to see what happens with all of the economic data, and most importantly, what is going on with inflation. Because remember, the whole effort behind the Federal Reserve right now is to lower some of this historic inflation that we've been dealing with for a very, very long time. In fact, have you ever wondered, why didn't the Federal Reserve do something, I don't know, a year ago when inflation was sitting at about 5 to 6%? Here we are over 9% as of the last reading, and now they're finally getting aggressive? Does that make any sense? Again, I'm just saying, why didn't they do something about this a year ago or more, right? Inflation back about a year ago was sitting around 5%, give or take a few tenths of a percent. So, why didn't they do it then? Again, not really sure, right? But anyway, the whole idea behind the Federal Reserve is to bring down some of this inflation. Well, the whole idea behind raising interest rates is to decrease the appetite for borrowing money, right? So for people like you and me and businesses, basically everybody in the economy, they want to raise interest rates so that when we want to go borrow money, as in get a loan, a business loan, get any kinds of credit, things like this, we look at the current interest rate and we say, not interested. No thanks. I am not interested in paying 5.5%, 6%, 6.5%, 7%, or even more percent on the money that I want to borrow, right? And again, depending on what kind of loan product you're looking at, you could be looking at anywhere between 5 and even 20% on some different loans out there. So yeah, right? The whole idea behind this is to lower and decrease the appetite for borrowing money. Therefore, if we're not borrowing money, that means we're probably not spending money either, right? And that's the whole idea behind bringing down this inflation. At the same time, one of the silver linings, and again, this is a very small silver lining, but I want to throw it out there because there actually is one little tidbit that's kind of good about all this. If you're somebody who happens to have a savings account at a bank that maybe has an interest rate tied to it, you might actually be seeing a little bit of an interest rate hike right now with all of these interest rate hikes out of the Federal Reserve as well. But however, don't get me wrong, you're still going to be losing a substantial amount of money due to inflation. So you might be getting 1%, maybe 1.25%, maybe 1.5% interest on your savings account. But at the end of the day, if inflation is still 9%, you're losing like 7.5% to inflation, right? So it doesn't make any sense. At the end of the day, you're still getting a little bit of something, but I guess that is one minor silver lining behind all of this. But anyway, shortly after the initial announcement came out of the Federal Reserve as far as what they're going to be doing with interest rates moving forward, then we got the announcements and we got the press conference out of the chairman of the Federal Reserve, Jerome Powell. So he generally comes out after the initial announcement takes place and he talks about a whole bunch of things, and then he talks about the economy, where they foresee things going from there, where they see the job market going, employment, economic data, all kinds of different things, and then their approach going forward into this. Now again, if you've ever listened to Jerome Powell speak during the press conference afterward, he's usually very careful with his words. So it's kind of interesting to listen to him speak because he's very, very careful with the things that he says, because he knows that a lot of people are listening very closely and they are digesting every last word that he is saying. Well, as a result of this, it's anticipated a few different things are going to happen with their next meeting in September, which is their next FOMC meeting. Now, these are the meetings that take place every 6 weeks, and this is where they determine what they're going to do with interest rates moving forward. Here's what I've seen today. I've been doing a bunch of research on this, and I've been reading as well as I've been listening to a variety of different experts looking at this. Here's what's interesting about it. A couple weeks ago, I was out in a video and said there's a pretty high likelihood that the Federal Reserve is going to come out and probably reverse and possibly even tame things down in their next meeting in September. Well, here's what I've been finding and the consensus across many people now. The likelihood of them coming forward with another 75 basis point rate hike in September and their next meeting is getting very small. In fact, there's a lot of people out there right now that anticipate the Federal Reserve is going to come in and probably lower that down to maybe 50 basis points, possibly even as low as 25 basis points yet again in their September meeting. It's all going to be predicated on the next inflation data report that we're going to get in about 2.5, maybe 3 weeks from right now is actually when we're going to get that next report on inflation for this current month right now. And then, of course, we're going to get the jobs report between now and then. And we're going to get a whole host of other economic data between now and then as well. It's going to be very important to watch all this stuff very closely to see what's going on with the economy, what's going on with jobs, what's going on with the unemployment rate, and what's going on with this inflation, right? So what the Federal Reserve is doing right now is rather than taking a proactive approach on inflation, they're taking a reactive approach. In other words, inflation is very high, so they're reacting to that by raising interest rates. Rather than being proactive a long, long time ago to get ahead of this inflation, they're deciding to be reactive as a result of this inflation. Well, is that necessarily the best solution? Well, at this point, it's too late, right? They can't really go back in time and do anything about it. But the fact of the matter is they are being reactive to the current inflationary environment. So here's the thing. Yes, they continue to raise interest rates, and they're likely going to continue raising interest rates. However, it's probably not going to be quite as aggressive unless we get the next inflation data report that comes out in a few weeks from right now, and maybe it's at 9.3, 9.4, 9.5%. If that's the case, then we could probably anticipate the Fed to continue moving forward with their aggressive interest rate policy. Now, here's what also is interesting. Jerome Powell, in his press conference after the initial announcement today, indicated there's no indication of a recession in the United States. Okay, well, tomorrow we're going to be getting the initial read on GDP for Q2 of 2022. Remember, what did we actually see as far as the kind of like the textbook example or the technical definition of a recession? Well, it's 2 quarters back-to-back of negative GDP growth. We already have the first quarter in the book. The first quarter of 2022, as in January, February, and March of 2022, was already posting a negative growth of negative 1.6%. That's already in the book. Well, Q2 of 2022 is also in the book, and we're going to be getting the first reading on GDP tomorrow. So I guess we'll have to continue to wait and see what happens there. But we'll be getting that reading tomorrow. Now, again, even if it comes in negative, I guess technically, according to the technical definitions of a recession, we would technically be in a recession at that point. But even in the chairman of the Federal Reserve, as well as the president and the administration were saying yesterday, no, actually they've been saying it for a couple of days now, no, we're not in a recession right now because all of the other factors that make up a recession are not there. However, the technical definition of a recession is those 2 quarters back-to-back with negative GDP growth. So again, if it's negative, technically, according to the technical definition, we would then be in a recession. But again, they're trying to change the rules. They're trying to change the definitions here, and we'll have to see what happens. But again, this will be out tomorrow, and we'll get that further reading. But between now and then, it is certainly going to be basically a wait-and-see approach to see what the Federal Reserve is going to do as far as the interest rates and what they're going to be seeing with all of this inflation and the latest data that we see coming out here in a matter of just a couple weeks from now. But either way, this was a very highly anticipated announcement out of the Fed today. In fact, the stock market went a little bit wild today after this announcement came out. Depending on the indices that you're looking at, the stock market was up anywhere between about 2 and 4%. The NASDAQ alone was up about 4% today. That's big. That's a lot. In fact, I said this yesterday in one of my videos. I said generally a 1% move in the market, who cares? Not a big deal. 1% is not a big deal. 2%, it's like, people are probably paying attention a little bit. There's a 2% move in the market. It's kind of a nice, decent move. 4% is a big, big move in the market, right? So that is a very significant move higher. But we'll have to see what happens here. Will we get a rug pull on this thing, or is this actually the start of the next bull market, and are we going to work our way out of this little bear market that we were in for a very short amount of time? We'll have to see what happens here, but again, from everything that I'm reading right now, a lot of strategists out there, a lot of people out there right now, even a report that was out yesterday suggesting 96% of bankers, as in like CEOs of banks, are suggesting that we're going into a recession for sure this year in 2022. So I don't quite think we're out of the woods yet, even though from the stock market perspective, it looks like we might be off to the races here. just be careful with that. If you are somebody who is investing right now, if you're looking at buying anything, just be very careful with that. You probably generally never want to buy after a big move higher like this. You typically want to wait for those pullbacks to buy when prices are a little bit lower, right? Get a little discount because why not? The market will always pull back and give a much better entry point. Anyway, so this was a highly anticipated announcement out of the Federal Reserve. And again, we'll have to continue watching here all these economic reports that come out here over the coming weeks, including the jobs report, the first Friday of the month in August. We'll need to continue watching the CPI data release in mid-August. That'll be released, and that'll be in conjunction to the inflation for the month of July. So there's a lot going on between now and then. Anyway, I wanted to bring you a quick update on the Federal Reserve, what they announced today, and which, by the way, stay tuned because yeah, if you have any kind of debt product out there right now, whether it's an adjustable rate mortgage, maybe it's a personal loan, an auto loan, student loans, maybe it's credit cards, anything like this, if it has any kind of adjustable rate to it, it's going to be just adjusted higher, okay? So if you didn't lock in anything, like if you were looking to buy a new house, for example, and you wanted to lock in your mortgage rate, I hope you did it a couple of days ago because now these rates are going to move higher. Even though the federal funds rate, as in the interest rate that the Federal Reserve indicates with these meetings, is not directly tied to mortgage rates, it's all correlated, and interest rates on mortgages will certainly be moving higher as well. And this is probably just going to come in and smash the real estate and housing market yet again even more, pushing more buyers out of the market. Anyway, we can talk about that in a separate video as that is its own topic in itself. So until next time, please make sure to subscribe down below. Totally free to do so. Share the video with your friends, family, social media, and go back and check out some of the other thousands of videos right here on the channel. Until next time, thanks so much for watching. I really do appreciate it. Have a nice day, and I'll catch you